What is going on, traders? So Deutsche Bank now is reporting that the markets are pricing in a 100% chance of a recession before the year ends. Now, what does this mean for investors, as everyone is really bracing for the bear market to be over and for the next bull rally to start? And what does history say about how the market performs during recessions? The data might be a lot more positive and surprising than you think, unless, of course, you've been following this channel, because we've been talking about this for a while, that the market is forward-looking. So usually the market already bottoms out before a recession ends. But we will get into the data that Deutsche Bank is looking at, why there's a 100% chance now that the market is pricing in a recession before the year ends, and what does this mean for your portfolio and stocks that you want to invest in, especially those of you that are sitting in cash right now. Basically, the big question on everybody's mind is, when is the stock market going to bottom out, and when are my stocks going to see green again? If this is the first time on the channel, welcome to The Traveling Trader. Leave a big fat thumbs up if you get anything out of this video. Let's get right into it. So if we take a look at the Fed fund futures curve, basically these are bets using the futures market on what the federal funds rate will be. Yes, you can actually bet on what the federal funds rate will be using futures. But just a few months ago in February, the prediction was that we would brace for a recession by December 2024. And now it is most likely, based on how institutions are betting in the Fed funds futures market, that a recession will come before January 2023, or in other terms, before the end of the year. We've already had a few markers that we see before recessions. The inverted yield curve between the 10-year and the 2-year. This has inverted multiple times already in 2022. And if we look at the real interest rate based on the yield on the 10-year tips, which is the inflation-adjusted 10-year Treasury security, you'll see that we are now in positive territory in terms of real interest rates. This is the nominal interest rate minus the expected inflation rate. We are now back in positive territory after being in negative territory all throughout the pandemic up until this point. And usually before recessions, we do see real interest rates turn positive once again. This is because usually before a recession, the Fed is doing some type of monetary tightening, as they are doing now. And before we talk about when the potential stock market bottom will be, and when the next potential bull market will start, it is worth discussing what we could do with bonds in terms of a trade. Because once the real interest rates on the 10-year tips turns positive, we normally see nominal interest rates decline. When investor fears drastically shift from being inflation-based to recession-based, we do see a whole round of bond buying, which tends to decline bond yields. Because remember, when bond prices go down, yields go up. When bond prices go up, yields go down. So as people buy more into bonds, the price of bonds go up as the demand rises, thereby reducing nominal yields. Because when investors are now afraid of a recession versus inflation, they're no longer afraid of a lengthy, aggressive monetary tightening by the Fed, because during a recession, the Fed will likely pump the brakes or even reverse monetary policy. And if we take a look at the last 17 recessions, only one of them resulted in the 10-year Treasury note going higher. 16 of them resulted in the 10-year note going lower. With that said, there might be a very lucrative play on a liquid ETF called TLT, an options play. And TLT is an ETF, which is a basket of long-term bonds. So if we are expecting yields to go down if a recession is announced, that means that the price of bonds will go up. So we will likely have some sort of play on calls on TLT, which I will send out in the Traveling Trader Academy. If you want to learn how to trade options, how to day trade, we just released our day trading course. If you want to learn how to trade futures, if you want the alerts, you want to chat with thousands of traders about potential trades and current trades, it's a great resource. Link is in the description, so sign up. All right, so when will we know when the stock market will bottom? Well, obviously, we don't know the exact answer to this, but if we take a look at some data, the median US recession lasts 14 months. But because the stock market discounts its future value 6 to 9 months, meaning the stock market is forward-looking, stocks always bottom out before a recession ends. And we tend to see a bottoming out process an average of 4 months before the end of a recession is declared. And if we take a look at the average returns when a recession is declared, 12-month returns after the end of the bear market during a recession, investors see an average of 49% gains from the bottoming out process. Okay, so let's list the current fears of the stock market and whether these things are priced in. The CPI came in at 9.1%, significantly higher than the 8.8% year-over-year projections and the 8.6% from the month prior. However, remember that CPI is backward-looking. It's a lagging indicator. We're talking about the CPI from June. Also, if we look at the core inflation data, meaning subtracting fuel and food, the core inflation is actually dropping. And if we look at companies' cost of production, those look like they are topping out as well. Now, I'm not saying inflation is not a problem, but I'm saying that is it more of a chance that inflation is topping out regardless of how long it stays at a topped out level, but is there more of a chance that inflation is topping out than growing? Well, based on how institutions are betting in the markets, the main fear now is a recession, not inflation. So I would say yes. And speaking of a recession, as we talked about at the outset, the markets are now pricing in 100% chance of a recession. So if that's the case, is this already priced in? Meaning, if come July 28th, which is the next GDP reading for Q2, if that comes out negative and we are officially in a recession, how much of a surprise is that going to be to investors? Probably not very surprising. You throw in the fact that every single time we have been thrown into a recession, the central banks have pivoted from their tightening policy. There's a good chance that the Fed is not going to remain as aggressive if we are officially in a recession. Now, remember, the next round of rate hikes are going to come on July 27th, and the market is already pricing in a 100 basis point rate hike. So if inflation is priced in, if a recession is priced in, if the Fed rate hike is priced in, what is the one thing that isn't priced in? Well, it's earnings, and we are officially in earnings season. Last week, as at the time of this recording, the major banks reported earnings, and they blew earnings out of the water, mainly due to rising interest rates and how that benefits their business model. However, how are rising rates going to fare for retail? How are rising rates going to fare for mega cap tech stocks, etc.? If earnings are negative mostly all across the board and companies don't provide guidance, or they provide negative guidance or less than expected guidance, then we could see another drop in the stock market. But is that drop going to be another 20 to 30%, or is it going to be incremental before the next rally or before the market finds a bottom? In my view, if the market hits bear market status, and moreover, if we are officially in a recession, to me, that is a signal, at least as it relates to my personal investment strategy, that is a signal to start gorging on quality stocks and indices. History shows time and time again, and you guys already know this, but human nature is funny like that. It's much easier to beat a bear market than a bull market. Since 1980, 60% of investment newsletters have beat the Wilshire 5000 index during a bear market versus less than 30% during a bull market. And as I stated already, when you invest in a bear market with a recession, the average returns 12 months after the bear market officially ends is 49%. Moreover, if you invest in quality stocks and indices, which would put your Sharpe ratio for your portfolio likely as 0.5% or above, over 10 years, you are 95% likely to beat out just a cash portfolio. So with that said, there are three things that I would focus on this earnings season when you're looking at companies to evaluate. You want to look at cash flows, you want to look at profit margin, and you want to look at guidance. Now, the SEC does not require companies to give guidance. As a matter of fact, they're not required to do that at all. However, companies do provide guidance because without that, their investors will lose confidence. So we want to look for companies that have better than expected guidance, or at least saying that they're going to meet previous guidance with the hopes of beating guidance if certain economic conditions are alleviated. And I wouldn't be too concerned with finding the absolute bottom. When you're looking at companies, look at companies that are clearly trading at a discount compared to what you think they will be in 5 to 10 years. If you look at Amazon down over 30%, and you look at its cash flows, its profit margin, its guidance, if you look at its future business verticals, do you think that Amazon right now is at a discount for 5 to 10 years or not? If you bought the indices each and every time they were in a bear market, you are guaranteed to make money regardless over the span of years. So I'm going to be paying close attention to July 28th GDP release and see if the economy officially hits recession status. If you guys follow this channel, you know in the Academy, we already sold cash secure puts that are massively up on stocks that we want to own. Tesla, Apple, Microsoft, the triple Qs, SPY, etc. But if we hit official recession status on July 28th, then I can no longer ignore the market and the downturn. I will start looking to strategically deploy cash in these quality stocks and indices. Remember that bear markets don't come around very often, and when they come around, they present opportunities for life-changing money if you have a long-term horizon. And it is the best way to invest in the market at a discount. Unfortunately, that is the time when fear is also at its highest. And again, that goes back to human nature. Anyway, traders, that is it for this video. If you got anything out of this, leave it a big fat thumbs up. Leave it in the comment section below. Let me know what you think the chances of a recession are, when you plan on investing. If you want access to the Traveling Trader Academy, link is in the description below. You get access to the courses, the Zoom calls, the chats, the alerts, the analysis, You get access to it all. It's a great value. Sign up. Link is in the description below. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.